That's not much at all. I have to really plan what I'm going to buy with that money.
For millions of seniors across the United States, anxiety about financial security in their twilight years is an ever-present psychological burden, especially as inflation erodes the value of lifelong accumulated pensions. However, 2026 is shaping up to be a historic milestone, a turning point bringing a breath of fresh air to the wallets of those who have dedicated their lives to society, as two critically important laws have officially gone into effect, promising to fundamentally change how taxes and benefits are calculated for retirees. The financial landscape for American seniors is undergoing a major surgery unprecedented in recent decades, driven by the convergence of two strategic legislative texts, the One Big Beautiful Bill Act and the Social Security Fairness Act. Public interest in these changes is at an all-time high, not only because of the scale of the tax deductions, but also because they address long-standing inequities in the Social Security system. Following the timeline of recent legal events, 2025 became a pivotal year as Congress and the federal government successively passed powerful financial support measures, creating momentum for a promising 2026 tax filing season. The center of attention is now focused on the Internal Revenue Service, IRS, and the Social Security Administration, SSA, the two agencies directly responsible for implementing these new regulations for every household. The legal framework for these changes rests on two main pillars enacted in 2025. First is the One Big Beautiful Bill Act, also known as OBBBA, Public Law 119-21, signed by the President on July 4, 2025, coinciding with Independence Day and carrying a message of financial freedom. Following that is the Social Security Fairness Act, signed earlier on January 5, 2025, marking a victory for the movement advocating for the rights of retired civil servants. The IRS officially released detailed implementation guidance through document number FS 2025-03 on July 14, 2025, with updates on July 25, 2025, to ensure citizens clearly understand the process. Meanwhile, the Legislative Commission on Pensions and Retirement and Congress have also issued notices confirming the repeal of restrictive benefit provisions, paving the way for retroactive payments. Delving into precise content from government sources and mainstream press, the most noticeable change comes from the OBBBA, with the establishment of a completely new tax deduction specifically for seniors. According to the IRS release, effective from the 2025 tax year through the end of 2028, individuals aged 65 and older will be eligible for an additional deduction of $6,000. This is a deduction separate from and in addition to the standard deduction for seniors that already existed under prior law. For married couples filing jointly where both are over 65, this additional deduction doubles to $12,000. However, it is important to note that this deduction does not apply unconditionally to everyone. The IRS has clearly stipulated income limits, whereby this benefit will begin to phase out if the filer's adjusted gross income exceeds $75,000 for single filers or $150,000 for married couples. Simultaneously, the Social Security Fairness Act brings good news to the group of retired public servants, including teachers, police officers, firefighters, and postal workers. According to a report from the Legislative Commission on Pensions and Retirement published on September 30, 2025, this act officially repealed two controversial regulations that had persisted for decades: the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO. Previously, these two provisions significantly reduced or even completely eliminated the Social Security benefits of those receiving pensions from work not covered by Social Security taxes. This repeal is not only effective for the future, but is also applied retroactively, starting in January 2024. The SSA began issuing lump sum payments to compensate for previously withheld benefits, starting in February 2025, providing an immediate financial resource for millions of households. Regarding specific data and figures for the 2026 tax filing season, the AARP, based on data released by the IRS on October 9, 2025, has provided a comprehensive picture of the new tax brackets. The basic standard deduction for 2026 has been adjusted upward to $16,100 for single filers and $32,200 for married couples filing jointly. Additionally, the extra standard deduction for the elderly under the old law has also been adjusted for inflation, rising to $1,650 for single filers and $1,300 for each spouse in a married couple. When combining all these amounts with the new $6,000 from the OBBBA, a single person over 65 could enjoy a total deduction of up to approximately $24,150. This figure creates a significant tax-free zone, helping to protect a large portion of retirement income from federal tax cuts. Furthermore, the cap on state and local tax deductions, known as the SALT cap, has been raised to $40,000 starting in 2025, a four-fold increase from the previous $10,000 limit, relieving major pressure for residents in high-tax states. Viewed from a multi-sector perspective, these changes are not merely tax matters but have deep impacts on the macroeconomy and the labor market. The OBBBA also includes provisions for tax exemptions on tips and overtime pay, a move designed to encourage workers to participate more actively in the service and manufacturing markets. According to analysis from Fidelity on October 22, 2025, allowing the deduction of auto loan interest up to $10,000 for U.S.-made vehicles is also a key stimulus lever for the domestic automotive industry. However, economic experts also warn of pressure on the federal budget as tax revenue decreases while benefit payouts increase. The increase in the SALT cap and new deductions may alter household consumption and investment behaviors, shifting cash flow from tax payments to personal consumption and healthcare, a sector that accounts for a large proportion of senior spending. Although the new policies have received widespread support, there remain opposing views and debates regarding their fairness and long-term effectiveness. The Bipartisan Policy Center, in an analysis dated June 12, 2025, pointed out a distinct difference between completely eliminating taxes on Social Security benefits and applying the $6,000 deduction. The center's experts argue that a total tax elimination would disproportionately benefit the wealthy, whereas the fixed $6,000 deduction with a phase-out mechanism better and more evenly supports the middle and upper middle class. The phase-out mechanism is designed at 6 cents for every dollar of income over the threshold, ensuring support is focused on those who truly need it without creating marginal tax rate shocks. Fidelity also spoke up to correct common misconceptions, clarifying that the OBBBA does not abolish federal taxes on Social Security as rumored, but only indirectly reduces this burden through deductions. The practical impact of these policies on beneficiaries is visibly clear and positive, especially for the middle-income senior group. By combining the increased standard deduction with the targeted $6,000 deduction, many retirees will see their federal tax liability reduced to zero or a very low level. For approximately 2 million people affected by WEP and 750,000 people affected by GPO, the repeal of these provisions means they regain the full value of their labor, no longer being penalized for dedicating themselves to the public sector. This is particularly meaningful for low and middle-income households, where every pension dollar plays a life and death role in paying for food, medicine, and housing. However, those with very high incomes will not benefit from the $6,000 deduction due to the income limit mechanism, reflecting the redistributive nature of the new tax policy. Regarding the upcoming schedule, citizens need to note key milestones to ensure their rights. The $6,000 deduction and tax changes of the OBBBA are effective for the 2025 tax year, meaning they will be realized when citizens file their returns in early 2026. These regulations are designed as temporary measures and will expire after 2028, absent a congressional extension. Regarding the Social Security Fairness Act, the disbursement of retroactive payments began in February 2025, but those who have not received notification need to proactively contact the SSA to review their records. 2026 will be the first year citizens truly feel the full impact of these laws through their tax returns, requiring thorough preparation of documentation and knowledge to optimize deductions. In summary, 2026 marks a new era in tax and welfare policy for seniors in the U.S., with the advent of the One Big Beautiful Bill Act and the Social Security Fairness Act. These changes not only bring direct financial benefits through increased deductions and the repeal of outdated restrictive regulations, but also represent society's recognition of the contributions of seniors and retired public servants. Mastering the regulations on income limits, effective dates, and how to combine deductions will be the key for every citizen to maximize their benefits. In a context of lingering economic volatility, these policies act as a solid social safety shield, helping millions of Americans feel more secure on their journey through old age. Experts recommend that citizens closely monitor subsequent guidance from the IRS and consult tax professionals to best prepare for the upcoming tax season.